Hi everyone, welcome back to the podcast. Happy Gandhi Jayanti. I hope you are having a wonderful day ahead. It must be a holiday for most of us Indians. Those of you who are not in India, I'm sorry, you must be working today. So I hope you have a wonderful day ahead and it's productive as always. So what am I going to talk about today on Gandhi Jayanti? Well, I want to talk about how 30-year home loans or mortgages are really a trap for people who are below the age of 40. And why am I saying this? While opting for a 30-year home loan may seem like a financially sound decision, especially when you're comparing it to renting, it's essential to consider the long-term implications of taking a home loan for such a long period of time. The concept of long-term mortgage is relatively new here. It's gained popularity, and many Indian banks are offering home loans that extend tenures far exceeding 20 years. Now SBIs are even offering 30 years. Historically, home ownership was always looked upon as a privilege of the wealthy. With shorter mortgage terms and substantial down payments, the system ensured that interest payments were relatively low. Because when the time period is short and the loan amount, even if it is large, with a large down payment, the actual interest you're paying to the bank is low. It's not so high. But in Indian housing finance landscape has evolved over the years, and the shift has come towards longer mortgage tenors and reduced upfront payment. That means more of the middle class and lower middle class can enter the housing market. This change is driven by an increase in demand for affordable housing in India. Banks have pushed for longer mortgage durations to maximize their profits because through interest payments. If you have looked at any graph, and I strongly suggest you open an EMI calculator, as I famously have said many times, punch in the numbers, and just for argument's sake, I'm talking about a 75 lakh loan for 30 years at 9.55% interest. The EMI will be 63,000 rupees a month. By end of the tenor for the 75 lakhs, you would have paid interest alone. You would have paid a total interest of 1.5 crores, and the total payment to the bank, including the principal amount, will be 2.3 crores. So let those numbers kind of digest in your mind what I'm saying. You've taken a loan for 75 lakhs for 30 years. And into those 30 years, when you finish paying it, the asset which you have is no more an asset because your flat, which you would have only bought a flat for 75 lakhs, will not be worth 2.5 crores. Trust me, because the flat is 30 years old. And the bank would have lived off your back, taking you for a ride of 1.5 crores. This is a problem when you're taking. This is why banks push for these long mortgage loans, saying it's a benefit. The transition of 30-year mortgage is benefited to the bank alone. But the homeowners like us are often paying the banks on hefty interest upfront because we pay interest first, then only we start paying the principal much later. In the same example, this depreciating balance sheet, as they say, of depreciating interest, which is shown. First, when you're paying the EMI, majority of the EMI goes towards paying the interest. You only start crossing over and principal starts overtaking the interest payment closer to the 25th years. So till the 25th year, the majority of the payment you're making to the bank is just interest. So even if you wish to foreclose the loan, you'll be having to pay a huge chunk of the principal still. So that's how this product is structured. And Indian banks also aim to attract more home buyers by offering extended tenor options by focusing on affordability and convenience for the customer. So really think about it. With a 30-year mortgage, more initial payment go towards interest rather than the principal. Homeowners like us don't start paying for the building or building any significant equity until the mortgage is well into the loan is well into its tenor. Meaning out of a 30-year, you have to wait for a good 22 years before you start building equity, home equity, which means actually putting down the principal and start owning the property. Till then, the bank still owns the property. You're still living off the bank's back. They're your landlords, in essence. Instead of taking a rent from someone, third person, you're renting the property from the bank and you're paying quite a lot of money for it. Borrowers in India face these kind of challenges. The initial payment paid towards interest. However, recent regulatory changes have aimed trying to address this issue by linking home loan interest rates to external benchmarks. I don't know how far this is, but I don't think this is of much use. Because for many individuals, especially for the age of under 40, imagine you're 35 years, you're 30 years old and you've taken on this 30-year loan. By the time you finish paying off this loan, you'll be nearing 60. If KSF takes this loan now at the age of 24, By the time he finishes paying the loan, he'll be 55 years old. By the time he's 55, trust me, his frame of mind will be quite different for the property he would have been paying for. Especially for those under 40, moving in within the first decade of home ownership is common. This can trap them into a cycle of paying interest upfront for each move. Because each time you try and move your home loan, you're paying more and more, interest gets reset. So even if you're trying to refinance your loan, lower the interest cost, you reset the clock again, and again you'll be paying interest all over again upfront. India's urbanized society, job challenges and lifestyle preferences often can lead to relocation too. So with all this stuck, this impacts mobility for the homeowner like Kesav. He won't be able to move to a better job. If he is moving, he has to put this place up for rent. And God knows if there's rent, whomever is going to be taking it will take care of the property and pay his rent on time. So Kesav can pay the EMI. And wherever he's relocated to, he won't be able to afford another house there other than renting it. So this is something to really think long and hard about before you decide to take these really long loans. If homeowners move and need a new mortgage, they must face higher housing prices and interest rates again, leading to increased indebtedness. And there's been this coupled with fluctuations in housing prices and interest rates, we buyers must consider these factors even before deciding to buy a house or take a loan. There are alternate options to this when there's so much uncertainty in the long-term residence plan. Long-term renting, long-term leasing are options. I would always say rent. I'm a big believer in renting. I'm sure I'll have a lot of people in the comments down below lighting it up saying, sir, yeah, but you're paying rent and you're not getting anything. Yes, but you can invest. And I've spoken about this also in many videos, which I ask you guys to rewind and look at. So this is the main problem with taking these long 30-year home loans, particularly for young individuals who are just starting their career. Please do consider it 1,000,000 times in this current environment we are living in, where there's so much of uncertainty in the market, and we're talking about global recessions, and we're worried about job security. Taking on a burden of a home loan can be devastating. I would rather say wait for some time, wait for the markets to make sense, prices in the markets for homes to make sense before you venture out into this. The importance of understanding the implications of loans is very important, and looking at alternatives is based on individual circumstances. I do understand that. So consider all your options before you decide to bite the bullet and buy a home and take a home loan. Financial goals and lifestyle choices should be aligned to your home loans. Keep this in mind. I hope this is food for thought on this lovely holiday which you guys are enjoying. Do think about all this before you take your next home loan. Thank you for being with me today morning, and I hope you have a wonderful day ahead.